This is the Daily Market Comment by Rafi Boyadjian. I'm Maria Pachurdiz. Thanks for joining us at XM.com. The European Central Bank threw its rule book out the window on Thursday as policymakers defied their own forward guidance of a 25 basis point rate hike to lift their three main lending rates by 50 basis points. The move effectively marks the end of negative rates for the euro area. As expected, the central bank also introduced its new anti-fragmentation tool, the Transmission Protection Instrument, or TPI. The euro spiked up on the hawkish announcement, but it didn't take long for the excitement to evaporate. It all started to go wrong for the euro when President Lagarde suggested that the ultimate point of arrival as to how far policy will be tightened has merely been accelerated, not changed, when speaking to reporters in her press briefing. Worries about how TPI will work are also weighing on the single currency. Despite all the hype, Lagarde has left a lot of questions unanswered about how the ECB would tackle a potential debt crisis sparked by Italy's political turmoil. It comes after Italy's national unity government imploded, leading Prime Minister Mario Draghi to resign, and a snap election being called for September 25th. Adding to the euro area's gloomy outlook on Friday are much worse than expected flash PMI readings. Manufacturing activity declined in July for the first time in 2 years. There's a real danger that the Eurozone economy will contract in the third quarter and is headed for a recession, as sanctions against Russia are only being stepped up. In response, Russia is trying to apply pressure on European governments by reducing gas flows via the Nord Stream 1 pipeline. U.S. PMIs will be watched later in the day for any signs that growth in the world's largest economy is also stalling. Jobless claims in America inched up again last week, raising worries that the labor market is cooling. The renewed jitters about slowing growth in the major economies are lifting the U.S. dollar, but dragging yields lower. However, the fresh slide in yields is shielding equities from a major sell-off after Snapchat owner, Snap Inc., yesterday warned that income from online advertising could slump in the coming quarters. The company's shares plummeted in after-hours trading, and Nasdaq futures fell as other tech stocks came under pressure too. But Nasdaq futures have since pared some of the losses, and S&P 500 futures are only slightly down. This was today's Daily Market Comment. Thanks for joining us at XM.com.